The Magnificent Seven may no longer be so magnificent. After more than a decade of overweighting tech, veteran strategist at Yardeni now advises investors to pull back, warning profit margins are under threat. He's even urging investors to look beyond the US. So, why the shift? We'll ask him in just a few minutes. Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. China is back in favor with global investors, with funds betting stocks will extend a $2.4 trillion rally. JPMorgan's chief China equity strategist Wendy Liu joins us to discuss whether she sees risks on the horizon, especially around the property sector. India facing one of its worst air travel disruptions as its dominant airline IndiGo cancels hundreds of flights due to crew shortages. The government is blaming the airline, but should it shoulder some of the blame as well? We put that question to aviation expert Vandana Singh. And also ahead, Indian pharma giant Biocon will buy out minority shareholders in its Biologics unit for $5.5 billion. Founder Kiran Mazumdar-Shaw will be joining us exclusively for that. Caution dominating trades in Asia as investors prepare to navigate a heavy slate of central bank decisions this week. Stocks moving in tight ranges, with traders already pricing in a 25 basis point Fed rate cut. That's despite growing unease among some policymakers that inflation remains too high. Meanwhile, China's November trade data is also due today, with exports likely rebounding despite shipments to the U.S. remaining soft. In terms of trading calls, we're monitoring Yardeni research as it makes a major shift in the allocation strategy that is capped for the last 15 years. It's now recommending effectively going underweight the mega cap tech stocks versus the rest of the S&P 500. Veteran strategist at Yardeni says he sees more competitors coming for the juicy profit margins of the Mag 7. Yardeni is also seeing little reason to stay overweight on the U.S. In the all-country world MSCI portfolio, some global peers have outperformed the S&P 500 this year on cheaper valuations and the weaker dollar. Let's talk to the man himself. Ed Yardeni is president at Yardeni Research. And Ed, why that change? It is a massive change for you.
Well, it's always time to think about the future when you get to the end of a year. 2025 is almost over. We're now thinking about 2026. I've been recommending overweighting information technology communication service since 2010. The problem is it's worked all too well. The two sectors now account for a humongous 45% of the market cap of the S&P 500. Of course, their earnings share has also increased, but nowhere near as far. And the same thing can be said about looking at the U.S. versus the global economy. When you look at the U.S. MSCI relative to the world MSCI index, what you see is the U.S. now accounts for 65% of the market cap of the world stock market. So it's hard to recommend overweighting something that's already quite overweight. I mean, if you just told people just to maintain the current weight of the index, that would still be an overweight position relative to what most people would think would be a diversified portfolio.
And what's fundamentally changed? Because when we talk about, overstretched valuations, they've been that way for a very long time now. And when you take a look at the AI cycle, people still point to how it is still at the nascent stage.
Well, I would say with regards to the Magnificent Seven, what's I think has changed is they're competing more aggressively against each other, and they've got more competition coming out of nowhere and somewhere on a regular basis here. We recently saw that Google introduced Gemini 3, which suddenly made everybody kind of reconsider just how strong the position is of OpenAI and OpenAI's relationship to lots of other AI-related companies. And then just at the same time, DeepSeek came back. Remember, DeepSeek when it introduced its model back in January of this year, kind of shocked everybody because they were able to put together a pretty good AI model that worked as well as some of the other ones in the United States, but apparently it was trained on chips that cost a lot less. And now it looks like they're doing it again, and there's some talk that the latest version of the DeepSeek model is just as good as Gemini 3. So there's a lot of competition. The profit margins have been awfully high from the Magnificent Seven. That usually invites a lot of competition, and that's exactly what's happening. And by the way, once you look at the S&P 500 and look outside of the Magnificent Seven, there's what I call the impressive 493. There's still plenty of good stocks out there of companies that are going to be using all these technologies, are using all these technologies to increase their productivity and to increase their profit margins. So I think broadening out a portfolio from the Magnificent Seven to the 493 makes sense to me.
Add lots of money sloshing around, tech companies spending a lot, investing a lot. In fact, we're just getting news that IBM is nearing about an $11 billion deal for Confluent. That's according to Wall Street Journal. What do you make of, the kind of investments these companies are making, and how might this play out?
Yeah, everybody's jockeying around for position. Nobody's quite sure how this all plays out. I mean, this could be a horse race that just never ends. When NVIDIA and OpenAI were kind of leading the way, of course, OpenAI is a private company, but companies that were related to OpenAI were certainly leading the way in the AI race. Suddenly, Google comes out of nowhere and claims that they've got a better model, and apparently it's been corroborated that they do have a better model, and it's done on cheaper chips instead of NVIDIA's GPUs. It's done on Google's TPUs, and Google basically has it all. So right now, Google looks to be in the lead, but this is a very, very dynamic situation that will change. By the way, I think we really have to view all companies, particularly the impressive 493, as technology companies. Everybody's using technology to make themselves more efficient, to cut their costs, to increase their productivity, to deal with the shortage of skilled labor. And so I continue to recommend overweight and more financial and individuals, and something that I haven't really touched is healthcare. And all these three sectors have tremendous potential to increase their profit margins with the technologies that are out there. And it's not just AI, it's robotics, it's automation, it's lots of innovations that I think are going to continue to make this a very rapidly moving investment landscape.
And if you're underweight Mag 7, will you be overweight Chinese tech? Have you changed your mind about China and China tech and all its AI plays?
Well, the Magnificent Seven account for 30% of the S&P 500. So it's the same issue I have. We're looking at it another way, and that's information technology and communication services. Now, with regards to a global portfolio, I have been recommending since 2010 what I call stay home, which is overweighting the United States. The problem is the United States is 65% now, as I mentioned before, of the market cap of the MSCI. So yes, I would broaden out to a global portfolio, including emerging markets, for sure. I think China has proven
emerging markets, but how about in China in particular, Ed?
Yeah, well, I was going to mention that in particular in China, the history of investing in China is it's awfully volatile. It's really more for traders than it is for investors. Maybe that's about to change. But I'm not convinced of that because the government plays such a large role in determining the winners and losers in the China market. But there certainly have been opportunities. I mean, the healthcare sector, if you ask most uninformed people which sectors in China have done the best, very few would have picked healthcare, and that's what's done very well. And that makes sense in the context of their demographic profile. So healthcare may continue to do very well. I don't know that you need to overweight technology in China if you're going to underweight it in the United States. I think there are plenty of other opportunities. I mean, we've seen Spain and Poland doing very well in Europe. Brazil and Mexico have done very well. India's been a big underperformer, but I think it'll have a better year in 2026.
The thing is, China wants to develop its own AI champions. It is investing, it is spending a lot of money in the space. And when you take a look at valuations of these AI players in China, they're still very cheap versus the global rivals. And add to that, foreign funds are coming back. The likes of Man, the likes of Fidelity, they are already back. So that could be a change in sentiment.
It very well could be a change in sentiment, and they are cheaper in China. But the way I'm looking at it is on a global basis, technology and communication services are sectors that are becoming increasingly very, very competitive. They have very high profit margins, and high profit margins attract wannabe competitors. And there's plenty of opportunities to muscle into the areas that these mega cap companies, whether they be in the United States or China, have been in dominating. And so I think the competitive issue is what's kind of at the top of my concerns about continuing to overweight technology and communication services. And I think it's very important to stress that these are already very huge market cap industries compared to the overall market cap of either the domestic U.S. market or the global market.
Do you think that the U.S.-China trade tensions, trade war, if you please, is still a huge risk for investments in China?
Well, I think both China and the United States have so far been realizing that they both still need each other. And I think we've sort of got a 1 year ceasefire here between the United States and China, where they're going to kind of leave things as they are. Let's see how things kind of shape up once that period is over. But I think there's still risk in that, because the reality is that the Chinese economic model hasn't really changed much. It's still very dependent on exports. And while China is cutting back its exports to the United States, it doesn't want to be as dependent on the United States. It's doing extremely well in the rest of the world. And the rest of the world is starting to kind of come to the same conclusion as the United States. And that is a lot of Chinese companies are subsidized or supported by the government. They're not necessarily playing fair. And they're putting important businesses, industries out of business in the countries that they continue to grow their market share of what they export. So I think China is still going to get some pushback now, maybe from more countries rather than just the United States.
And we're also keeping an eye on the Fed, widely expected to cut rates on Wednesday, adding to the rate cuts that we've seen so far. Why is it that yields continue to rise? In fact, yields are right back where they were before the Fed started cutting rates.
That's been my point since last year. Last year, when they started cutting rates, I said I thought that was a mistake. I thought the economy was resilient. And Fed officials had this view that the federal funds rate was still restrictive and it had to be brought down. And they just have this preoccupation with the federal funds rate. I guess that's because of what they can control. But what really kind of blew them out of the water, I think, is that as they lowered the Fed funds rate by 100 basis points last year, guess what? As you said, the bond yield went up 100 basis points. So how can they really say that they're easing when the bond market kind of completely offsets that? And I would argue the bond market's more important because it's related to the mortgage market, whereas the Fed funds rate really is just an overnight rate for bank reserves. And now it looks like it's happening again. They cut already by 50 basis points this year. They'll most likely do it again on December 10th this week, so 75 basis points. And they may not, the 10-year bond yield may not cooperate. You know, these are my friends, the bond vigilantes, who basically say, well, if the Fed's not going to maintain law and order in the capital markets, they're going to do it. And so far, the Fed's attempts to ease have been offset by what the bond vigilantes have been doing.
Trump has been pretty clear. He wants long-term yields to be much lower from here. What will that take? And would Kevin Hassett make a difference? Can he actually navigate this situation and, help trend long-term yields lower?
I don't think it's possible. I mean, no matter what loyalist winds up being the Fed chair and kind of caters to Trump's wishes, which is to lower interest rates down to 1%. I mean, that's what Trump has said a few times. The problem with that is, perversely, I think the Fed is actually about to become more independent in the sense that individual voters at the Federal Open Market Committee are going to say, you know what, we don't have to toe the line anymore. We don't have to kind of bow to the Fed chair because the Fed chair wants to have a consensus that is consistent with their views. And so we could have more dissenters than usual. We could have a very odd situation, an unusual situation that Volcker faced, where the Fed chair votes to lower rates, and he loses that vote because the majority doesn't want to lower rates. And then, of course, if he gets his way, if somehow or other I'm wrong about all that, and whatever the new Fed chair wants, the new Fed chair gets, the bond vigilantes will protest dramatically. Look, the bond market, bond vigilantes right now went on the sightseeing trip in Japan, and then they looked around and said, "Oh my God, they got a debt crisis here. Let's act." And you've seen the bond yields in Japan demonstrate what could happen when the bond vigilantes turn on the fiscal excesses of a government.
Right.
We've seen that in the UK as well. And I think it's one of the reasons that the bond yield is still above 4% in the US is, the debt situation, there's nothing that we're doing to improve it. Quite the opposite. The Big Beautiful Bill Act is going to cut taxes pretty significantly next year. And by the way, those tax cuts include tax cuts for this year, which weren't paid because they couldn't change the tax code fast enough. So we're all going to get these big refunds.
Ed, I just want to break the China trade data. We've been waiting for the numbers.
Sure.
China's November trade data in terms of exports in USD terms rising 5.9% year on year. That's way higher than the estimate of 4%. In terms of imports in USD terms, rising 1.9% year on year versus an estimate of 3%. So exports seem to be resilient as found markets to counter the U.S. market. So it does seem like China is in a pretty resilient position. Is that enough for you to perhaps be more confident about investing in a market like China?
Look, I'm not telling anybody not to invest in China on a short-term basis. It's just kind of the long-term I have an issue with. And right now, China is doing well, and the rally will most likely continue. The government is continuing to rely on the export model to generate growth, and looks like it's still working. But there's going to be pushback, as I said, political pushback from other countries that view what China is doing with their exports as dumping in global markets and threatening healthy industries with subsidized exports.
Ed, before we let you go, I just would like you to weigh in on the Netflix Warner Brothers deal. President Trump has come out to say he's taking issue. He finds it problematic because of the market share of the merged entity. What's your take on that?
Well, these things get extremely political, and you pick up the rock and you see there's a lot of moving parts to the story, and so I'm not privy to all the issues that are being considered in Washington, but I don't really have a problem with the deal. I think it's a good deal for both parties, and I don't think it really creates a monopolistic situation, because technology is monopolies don't last very long because somebody figures out how to compete against them. And there's certainly plenty of other streaming services. So I personally have no problem with the deal.
Ed, always a pleasure to have you on the show. Ed Yardeni, president at Yardeni Research. We thank you so much for your time today. Still ahead this hour, China-Japan ties under further strain after conflicting versions of an encounter between military aircraft. More details just ahead. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. Tensions between Japan and China have intensified over the weekend, with the two countries giving conflicting accounts of an incident involving fighter jets near Okinawa. For the latest, let's bring in our Chief North Asia correspondent, Stephen Angle. Steve, what do we know?
Well, we do know that there's two different narratives being spun right now in Tokyo and in Beijing over this incident or incidents that happened on Saturday. Essentially, you have the Liaoning aircraft carrier of the Chinese PLA Navy sailing east of the Miyako Strait, south of Okinawa, near the Senkaku Islands, which are disputed islands as well. China calls them the Diaoyu Islands. And they were doing some training flights with their J-15 fighter jets, and then out of Okinawa you have Japanese forces with their F-15s. They scrambled jets to intercept them to make sure that these Chinese jets wouldn't cross over from international waters into Japanese airspace. The Chinese say those scrambled jets of the Japanese Air Force got a little too close, causing grave concern and hazards for the Chinese pilots. This is what the Japanese defense minister Koizumi had to say, his narrative.
This radar illumination was a dangerous act that exceeded the scope necessary for the safe flight of aircraft. We find it extremely regrettable that such an incident occurred, and we lodged a strong protest with the Chinese side, firmly requesting measures to prevent any recurrence.
So you heard Koizumi-san say radar illumination. That is basically locking in a live fire targeting of the Japanese jets. And again, the Chinese side has been using that narrative as well. And that terminology, we have a full screen from the Chinese Ministry of Foreign Affairs, essentially saying that by using radar illumination terminology, Japan is deliberately making a false accusation against China to build up tension and mislead the international community. It is purely ill-intentioned. So that's what I meant when I said there are different competing narratives. It's not disputed that this intercept, if you will, happened, but it's the intent, given the backdrop right now of increased tensions because of those comments over Taiwan from the Prime Minister of Japan, Takaichi-san, which of course has led to a chill between Japan and China, which doesn't seem to be thawing anytime soon.
And these are concerning developments. Our Chief North Asia correspondent, Stephen Angle, thank you so much for that. Still to come, Indian regulators demand an explanation from IndiGo's CEO after the country's biggest airline had to cancel almost half its flights in a day. That story coming up next. This is Bloomberg. Welcome back. You're watching Insight. Here's a quick look at where markets stand. China heading to lunge after exports rebounded in November, pushing the trade surplus past $1 trillion for the first time in any year. Japan also coming back online after the country earlier confirmed a deeper GDP decline in a revised report, giving some justification for Prime Minister Sanai Takaichi's stimulus package announced last month. And we're also on watch for the Indian rupee as it continues to weaken to fresh record lows. RBI Governor Sanjay Malhotra earlier said that the policy of managing the exchange rate's volatility has not changed, quashing speculation it was allowing large swings by staying on the sidelines. The Indian rupee currently trading at 89.99 as we speak. And staying with India, Indian airports in turmoil after the country's largest airline cancelled more than 2,000 flights in just days. Long queues, Stranded families and freight tempers have become the norm at major hubs across the country. Indian regulators have ordered the CEO of IndiGo to explain the severe disruptions which began last Tuesday. For more, let's bring in India aviation reporter Mihir Mishra in New Delhi. Mihir, what led to this disruption at IndiGo? I mean, it snowballed pretty quickly.
Yeah, hi, good morning. So the problem, we have to look at it in the context of the real reason for it is pilot shortage. Now, why that pilot shortage happened? Starting November 1st, India's aviation regulator asked airlines to provide more rest period to pilots, a restricted number of night flights and night landings that they could do. What that led to was a severe kind of a shortage of pilots at IndiGo. They were running very thin, with a very small margin of error. Now, they did operate flights during the month of November with cancellations, though the cancellations were not as huge as the past few days have seen. Then happened the Airbus software update that did impact their operations a little. Then happened a problem with the passenger check-in system on the night of Tuesday, which kind of triggered it. And starting Wednesday, they have been seeing cancellations. Now, the cancellations, they were trying to operate as many flights as possible with the cancellations, but then they realized that it's going out of hand. So on Saturday, they cancelled about more than half of their flights to ensure that they have enough pilots in the system. So essentially that was done to reset the system so that they can start afresh from Sunday. Now, if you look at flight operations from Sunday, there has been improvement. Their OTPs, or on-time performance, which was as low as 30% on Saturday, has increased to 75%. It will further continue to improve. There will be cancellations in the network, but flight operations will continue to remain better. And that is the focus of the airline going ahead, to ensure that flight operations come back to normal as soon as possible. Now, there is a big now there is also the regulator which is taking charge. They have been seeking responses from the airline as to why did they not plan it well, so that this pilot shortage snowballed to such kind of a flight cancellation that disrupted. And since IndiGo is the largest, yeah.
The question is, how soon operations will go back to normal? How have the other airlines and the Indian government reacted to it?
Yeah, so flight operations have kind of returned to partial normalcy. A full normalcy, the airline CEO and also the airline has said that they will be able to achieve it by December of 10th. Now that normalcy will happen, and it will gradually get better and get back to the earlier operational performance much before the starting of the holiday season. But the bigger issue now for the airline is to tackle the regulator. Now, the regulator, India's aviation regulator, is really concerned that maybe the IndiGo did not plan it well, did not plan the pilot availability well, which led to all these flight cancellations. They have sought responses from the airline. The airline was to respond by Sunday evening. They have sought 24 hours more, so their reply should go by the end of day on Monday. And the operations will continue to improve going ahead.
Mihir, thank you so much for that. Bloomberg India aviation reporter Mihir Mishra in New Delhi. Let's get perspective. Vandana Singh, chairperson at the Federation of Aviation Industry in India. Vandana, what's your take? I mean, what went wrong with IndiGo?
Thank you, Haslinda, for having me on your show. Firstly, looking at what went wrong, let's just go and break it down and go a little bit back into the background. The airlines, the Indian airlines, all of the Indian carriers have had almost about 2 years to comply with the new FDTL norms, flight duty time limitations that we call. Now, these are going in tandem, in line with the ICAO ACAO norms, which is the International Civil Aviation Organization, which is basically addressing pilot fatigue. And this is not specifically India. It's all over the world, all the carriers have been advised to address pilot fatigue. Now, here in India, the rest hours were 36 hours for the pilot. And as per the new FDTL norms, they were to be 48 hours for the pilots, plus the leave, right? And the new FDTL norms kicking in, at first, when the announcements were made last January and the implementation was to happen in July of 2024, then obviously the carriers were not prepared. There was a court case in which it was clearly advised that the implementation will happen from July of this year, which is 2025. Having said that, the airlines had enough time to build up on their shortages, to comply with the norms, the regulations, as per the aviation's laws of our country. The mandate was clear from the Directorate General of Civil Aviation, clearly given, and the draft was clear for them to be seen even as of last year. The problem started with IndiGo because the second phase that kicked in, first phase was 1st of July this year, and the extension happened to November of this year. Second phase was the deadline given by the court. So when 1st November came in, obviously IndiGo, with its dominant share in our Indian market at 62 to 65%, was not ready with their pilots, had not the trained first officers and the pilots needed for this, specifically the winter season right now. As we know, it started on October 26th, 2025, and will carry on to 31st March 2026. Not just that, they
but Vandana,
yes?
Indian Airlines had 20 months to comply. We've had the likes of SpiceJet, Akasa, being able to comply. How much of this has to do with perhaps IndiGo's aggressive expansion plan that is unable to comply with the new rules?
That is true, ma'am. You're saying that IndiGo basically has had very aggressive growth plans, especially for the night flight landings. So 8 flights were brought down to 2 as per the new FTTL norms. That also was affecting them. But the question here is that the response has to go now to the show cause notice by the Directorate General of Civil Aviation, and they have to respond. They have an extension to respond by 6 p.m. tomorrow evening, failing which action can be taken by the government as to why, everything came to, as you said, everything snowballed, or there was a proper meltdown, and why couldn't IndiGo manage things in a disciplined and a proper manner. Having said that, yesterday was day 7, today is new week, day 1, and I assume everything to get back into place by 10 to 15th of December. And I do expect that with the new regulation that has the extension given till 10th of February 2026, that things will be in order. But IndiGo definitely will be taken to task by our government. Definitely. Goes without saying.
As a result of the crisis, the government suspended the new rules. Did it set a precedent?
No, I don't think it will set a precedent. On the contrary, it is putting things in bold font, really in bold, that this kind of abuse of dominance, or what we call alternate non-adjustment, artificial adjustments is not going to work. This is not going to work. And it is clear to the Indian carriers that they have to comply with the norms. And more healthy competition is also being brought to the Indian skies, because we don't want to look at such a dangerous market share. I think in any industry, you would agree with me, Haslinda, that nobody wants to see a dangerous market share that is not healthy for any company, any industry, anywhere. So we expect more players to come in. We are bringing in more players, and we expect a proper explanation in time by IndiGo as to why this happened. And of course, meanwhile, all the refunds and all of the things are coming back to normalcy. On-time performance is coming up. Passengers are being taken care of. Refunds are being done. But this will not happen again. I can assure you that strict action has been taken, and these regulations have to be complied with. And I don't think anybody will take anybody for a ride now or take things for granted or arm twist for that matter. Over to you, ma'am.
This has been the worst incident in India's aviation history. Do you think the CEO of IndiGo should resign? Where does the blame lie?
Absolutely. You said it. The answer lies again in the question, where does the blame lie? The blame lies in the top management of IndiGo. The CEO is directly responsible for this because they clearly knew that they needed an X amount of pilots. In this case, at least there was a shortage of 65 captains and a shortage of odd 41 first officers, and the figure is low right now, but at least 150 required. Flights increasing in the winter season by about 826 flights because of the holiday season. So where were the pilots? CEO and the top management directly responsible. Crew resource management not done. Rostering not in place. So obviously the fingers point to the top management, and that CEO has to take the blame of it, ma'am. Over to you.
The crisis has highlighted the fragility of India's aviation industry. What reforms need to be taken, you think?
Good point. First of all, as you know, we are a very progressive and a resilient country. You know that. And what is being done immediately is we are bringing in healthy investment. We are opening up we already have open skies. We are bringing up healthy competition. A few carriers are there. Of course, the names are not known, but we are doing everything possible to bring about a sort of a balance in our skies. We are the fifth largest aviation market in the world and soon to be the third largest economy in the world. So we will not allow this to dampen in any way. We are going to make this brighter, bolder, and stronger. And you will see that soon, ma'am. Over to you.
Vandana, do you think IndiGo can recover from this crisis, or has trust been broken beyond repair?
Firstly, to be very honest, Haslinda, this incident is something that cannot be forgiven or it can be forgotten. Neither it will be forgotten nor it will be forgiven. So IndiGo definitely has lost its trust. And at this point of time, obviously, it has to regain its trust. I do feel that things are coming back on track, that it's going to do its best to, try and, come up to its image, take out the gray zones or the tarnished areas, like we say. Every day there is a message that's coming in now, full page of our newspapers, saying that we are sorry, mismanagement on our part, misjudgment on our part. So they're accepting the blame. They're accepting that they went badly wrong, and that too at a time when people like to travel the most in the month of December, which is the holiday season. So coming back to their image, I think the image is going to get restored, but it's going to take a lot of time because people have lost their confidence. And at this point, they are infuriated, they are aghast because of the harassment. But as I mentioned, we are a very resilient country, we are resilient people, and we will start flying IndiGo again. I, for one, always domestically fly IndiGo. They control 2/3 of our domestic market. I always fly them domestically, and I do know that in a while from now, I too will fly. But there has to be a balance of all sorts, and the balance is coming. Ma'am, over to you.
Do you see rivals like Air India capitalizing on the situation to gain market share?
Yes, Air India is struggling in its own space, if I can say that, with its structuring, restructuring, lots of issues with manpower, infrastructure, and all of that. But definitely, they are trying to also build up their image. They are also trying to strengthen their pilot strength. They were already prepared, mind you, for the FDTL second phase implementation on November 1st. So they did not have any such problem. The problem went right into IndiGo because they were controlling the maximum market share. So Air India definitely is coming up, and we expect Air India to get better and better in terms of its maintenance, in terms of its human resource management, crew resource management, and all of it. I do expect Air India to come up and command a certain market share, which is right now not that significant. Over to you.
Vandana, thank you so much for joining us today. Great assessment there. Vandana Singh, chairperson at Federation of Aviation Industry in India. And of course, India's been trading for about a minute now. We've been tracking IndiGo shares. They're down as much as 6.7% as India seeks explanation from CEO of IndiGo for the chaos that it's seen over the last several days. Again, IndiGo shares slumping as much as 6.7%, currently down about 5.5%. And in a surprise shakeup in the aviation industry, Qatar Airways has named Hamad Ali Al Khater as its new group CEO. Al Khater will succeed Badr Mohammed Al Mer, who spent just 2 years in the post. Let's bring in Bloomberg transport reporter Denny Lee. Denny, put this in perspective for us. Why the change?
Well, it's a surprise change that was announced on Sunday. No one really saw it coming, and it comes at a time when for example, Badr Al-Mir had spent only 2 years in the job. He actually replaced the very colourful Akbar Al-Bakr, who spent 27 years in the role. So it does raise questions about whether Badr Al-Mir's effectiveness running the airline was seen as in a positive light. And the announcement, whilst he was thanked for his efforts in the role, no clear answers as to where he's going next. And why specifically he's leaving. And for Hamad Ali Al Khater, coming across from the airport, he has big shoes to fill because Qatar Airways, one of the world's best airlines, biggest airlines in terms of premium travel, it has an aggressive expansion plan and has over 300 aircraft on order, is being very aggressive in its push for global dominance. And so he has a lot on his agenda in terms of expansion, and so with this change at the top of Qatar Airways, it's a very interesting one at that.
What are the biggest challenges for Al Khater as he takes over the helm, Danny?
Well, aside from perhaps the geopolitics in the region, and he will have to navigate, of course, making sure that he can get, for example, aircraft delivery on time. That has been a bit of a challenge for Qatar Airways, coming up short, not necessarily having all the aircraft it needs to pursue its very aggressive global expansion. And then there is the question of demand. How will that demand look like in 2026 and beyond? Because as we see with more volatility in oil prices, clearly that demand may change as customers may feel more tired by higher airfares.
And you got to wonder about that competition, how that might play out in the Middle East.
Yeah, no, absolutely. And it's a big reflection that someone like Sir Tim Clark of Emirates, he has been in his post for many, many decades now, and he has survived them all, frankly. From the changes at Qatar Airways, he's still in his post to this day.
Danny, thank you so much for that. Bloomberg transport reporter Denny Lee. Still to come, U.S.-India trade talks ramp up as the Modi government pushes for cuts to 50% tariffs. We have an update just ahead. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. India's tariff talks with the U.S. will pick up this week with visits from a senior State Department official and the team of American trade negotiators. For more, Bloomberg's India government reporter Sudhir Ranjan Sen. And of course, this, visit comes hot on the heels of the visit of Putin himself to India.
Well, yes. I mean, President Putin left India on late Saturday afternoon after a series of bilateral meetings with the Prime Minister. He met the President of India. There was a large team of contingent of Russian officials and businessmen who kind of accompanied President Putin. And this is the first visit that Putin did, staying overnight in India since the Ukraine war started.
And when it comes to Putin's visit to India, he really has managed to deepen ties with Prime Minister Modi.
Indeed, I mean, and it's a very interesting thing that has happened, in the bilateral visit that happened. One, India and Russia have both broadened their ties away from the traditional pillars of defense, nuclear energy, to trade and commerce. In fact, they've set a target of $100 billion of bilateral trade in the next 5 years, which is roughly a 145% jump from the current trade level. That's very, very important. Two, the two sides have also decided, and it's very clearly mentioned in the joint statement, saying that the defense ties are going to move away from the buyer-seller relationship to co-manufacturing and joint development, which is very, very significant.
Sudhi, do you think the trade deals that we've seen so far will manage to unlock bilateral trade between the two sides? They've underperformed all these years. Is it different this time round?
Well, there is a political will, at least, because, these figures come from the very top level, saying that we need to expand trade, we need to buy and explore that area. Interestingly, President Putin, in his interview to the India Today, one of the television channels in India, very clearly said that I've asked my team to figure out what else can be bought from India. So there is a political will, which we did not see earlier. And therefore, the trade was around $16 to $14 billion a year, largely on defense. And then, of course, after the Ukraine war, a jump because of crude oil purchases by India.
It's about nuclear, it's about clean energy. Sudhi, thank you so much for that. Bloomberg's India government reporter Sudhi Ranjan Sen. Still ahead on the program, JPMorgan's chief China equity strategist will be joining us as we look ahead to the coming year for Chinese stocks. We speak exclusively too with Biocon founder Kiran Mazumdar-Shaw about the deal to fully integrate their Biologics unit. And we'll be live at Abu Dhabi Finance Week for an exclusive interview with Bridgewater Associates founder Ray Dalio. More to come in the next hour of Insight. This is Bloomberg. Welcome back. You're watching Insight. We're keeping an eye on Indian airline stocks on the back of the worst chaos in Indian aviation history. We have IndiGo slumping on the back of news and on the back of the government seeking explanation from its CEO on what happened over the last several days. IndiGo stock slumping as much as 6.7%, currently down about 4% as we speak. Meantime, rival SpiceJet are surging about 12% right now. Of course, we have rival airlines trying to capitalize on the crisis that we've seen in India's aviation space. Now, we're also keeping an eye on developer Vanke, that's trading in Hong Kong. Take a look at where we are in terms of that company after trading in 7 of its yuan bonds were earlier halted after prices rose by over 20%. This comes after the company proposed delayed repayment of a second local bond. For more, China credit reporter Trista Singh is with us. Trista, what does this tell us about Vanke?
So Vanke decided not to exercise its right, which allowed it to redeem a yuan bond earlier, and then also it seek to delay a yuan no payment. That's the second one. So if we remember that last week it decided, seek to delay a yuan, the first yuan no, and right now we're seeing it seek to delay another one. So this comes not a surprise for investors because after last week's news, I think a lot of investors are expecting the similar move will come. But what we are watching next is about December 10th. Bondholder meetings Vanke will hold, and they will discuss the extension proposal.
What is expected then?
Yeah, I think in that meeting, last week we reported that some creditors are signaled to the developer that they will oppose to the plan. So, but the company's representative also told bondholders that there isn't much room for them to improve their terms. So we really need to wait and see the negotiation, like which direction it could go. But, if they fail to win the support from creditor, it could increase the potential risk of default. And then longer term, I think investors are largely expecting that restructuring could come at some point, because right now all the discussion are just trying to help Vanke to buy more time.
Trista, thank you so much for that. Bloomberg's China credit reporter Trista Singh. Now, despite lingering concerns over its property sector, China has won back global funds in a banner year for stocks, with investors anticipating further gains on the country's AI prowess and resilience amid U.S. tensions. Fund managers also expect this strength to extend through 2026. Our Asia Equities reporter Winnie Xu is with us. And Winnie, it seems like investors are pretty much bullish on Chinese stocks next year. What are the drivers here?
Yeah, there is a lot of optimism for Chinese stocks going into next year. I know you just had a conversation with Ed, who is a bit more concerned in terms of the longer-term potential for Chinese stocks. However, as we talked to the likes of Man Group, Fidelity, BNP Paribas, they were all quite bullish in terms of kind of how China's technological advancement and its self-sufficiency agenda, along with the policy stimulus that we are expecting from March, with the 5-year plan starting to kick off. That is likely going to help the economic outlook as well as the earnings improvement. So with that kind of in the picture, we are seeing a bit more upside to come from here. However, it most likely is going to be a slow bull run, as we see, for example, Morgan Stanley just seeing a bit of upside, about 6% from current level for the MSCI China till end of next year, while the gauge has actually risen about 30% so far this year. So yes, there is some optimism, but a bit less compared to what we've seen so far this year.
I guess the question is, who will drive the rally, foreign or domestic investors?
Yeah, that is a very good question, and that's what we've been asking around as well. For now, when you look at this year, actually foreign investors have mainly been on the sidelines. We have that data from Morgan Stanley saying that they see about $10 billion of net inflows from foreign investors so far this year. However, it's mainly driven by passive funds, while active funds actually show about $15 billion of outflow for this year for Chinese stocks. And as we talk to different fund managers, the foreign investors and foreign interest mainly has come from the investors who look at Asia, or investors who are based in Middle East, for example, but not so much when it comes to US or Europe-based investors, just because they are still a bit burned from what they had seen previously in terms of the boom and bust of Chinese stocks, and they need to see a bit more structural changes when it comes to earnings recovery and also the economy turning a bit more positive. And without that, it's very hard to expect more foreigners to turn more positive or to buy into Chinese stocks. However, when we spoke to Bank of America, she actually said that the foreign funds returning back to Chinese stocks is going to be that next leg for Chinese assets. While when we talked to Amundi, they actually said that Chinese stocks do not necessarily need foreign investors, just because how much cash cash we have from the domestic investors.
Are we likely to see a broadening of the rally? It's not just about AI, is it?
Exactly. Most likely that is also the bet that we're hearing. Of course, AI and tech is going to still be that bright spot. However, like you said, there are sectors and stocks that run so much, almost running ahead of its earnings already. But the related sectors, for example, whether it's power, materials, these are likely to gain further on this same thing. But also biotech and some of these supply chain related names are also AI related, but but still has further potential into next year. In terms of non-AI names, actually consumer stocks is one big highlight. When we talked to Man Group, they said that contrarian bet that they have is for AI staples to rise on the back of the reflationary environment expected for China.
Wendy Xu, Bloomberg's Asia equities reporter. Thank you so much for that. Let's get perspective and insights. Wendy Liu, Chief China Equity Strategist at JPMorgan. Wendy, China, I guess, is the comeback kid of 2025, up 30% year to date, among the best performers in the world. The question is whether that pace of gain is sustainable in 2026.
Yeah, we do think it's sustainable, but likely at a slightly lower pace. So for CSI 300, MSCI China, and even MSCI Hong Kong, we're forecasting on a range of 12 to 18% year-over-year increase in our price target. This will be primarily driven by earnings growth. I think one of the disappointment when looking at MSCI China this year is the headline EPS growth for 25 started the year at about 9. Then it went all the way to 1, but lately it's gone back to 3% year-over-year. But if we look at the revision breadth, it's actually had the best revision breadth since 2020 by 2 standard deviations. However, that was masked by the quick commerce platforms' intense price competition. If we take the company's feedback to be an indicator of where things could be for 2026, their view is that third quarter marks the peak of such competition. Then I think that the revision breadth will come into greater sort of a focus in 2026. And when we look at the broader macro, the momentum for 2025 was very much in the expansion zone. And occasionally there will be a bit of a pullback. Right now we're in a pullback. And I think once we get into the spring, there'll be a spring spurt. So we're going to be off to races again. And clearly since October, there's been a bit of consolidation. And we did highlight to our clients on October 12th that we think the growth and momentum names were getting crowded. And it's better to go for less crowded, high yielders, quality laggards, and etc. Yeah, so I think 2026 is looking pretty solid.
Some say that perhaps China's financial deregulation will also add to the rally in Chinese equities. What do you make of that?
I think the Chinese household, to your point, is sitting on a tremendous amount of investable liquidity, but they've lost money repeatedly in the onshore stock market, so they're still quite tentative. If I look at what the net wealth, i.e. deposit minus household debt, that was at around 20 trillion back in 2018. That number latest is sitting at 80 trillion. I think it's trying to figure out if the market can be trusted as a place that it can keep its wealth. So I think if the earnings come through, there'll be more of this transition or reallocation from fixed income products, deposit products, into equities onshore, to your very question.
$23 trillion in deposits is it's a huge amount of money. I'm just wondering, what will it take for foreign investors to come back? I mean, the reason I'm asking is because the bar is still very high. The U.S. market is still doing really well.
Yeah, I think the typical feedback from our global investors in U.S. and Europe is that if U.S. is doing well, yeah, valuation is not great, could be better, but the momentum is very strong. And if U.S. is doing well, I don't need to look very much beyond that. And I think in all practicality, that's been the case. So when we discuss with investors on the key thematics, there's very little pushback on Chinese exporters. Not too much pushback on anti-involution, although people question which sectors this will have the most immediate and lasting impact. And on the AI supercycle, I think depending on what you want to buy, there's not too much pushback. The pushback is really on consumption, whether property can stabilize at some point and household, with property being the biggest asset, can gain confidence and consume. And mind you, China has about $7 trillion USD in annual consumption. About 5 of that is in household. So that would be too big of an opportunity for people to ignore if that happens. I think that's what people are trying to figure out right now.
How much conviction is there in China's economy? We had export numbers coming in stronger than anticipated. How much has that already been priced into all the numbers we're seeing in China?
I think from the asset allocator standpoint, because the macro number tends to be mixed, so the conviction isn't very high, and there's a little bit of a geopolitical overhang, although near term, given the tactical détente between U.S. and China, that's not an issue either. From bottom up, we could see a very clear trend of recovery. But China has clearly gone ex-growth, so in the aggregate, the recovery isn't as obvious. And I can understand why people have difficulty in making a definitive call. But I think in 2026, we'll show further progress on growth year over year, quarter over quarter, and that will give people the conviction. So it's data dependent at this point. And one other thing I like to point out that ought to give people some confidence is when we look at the velocity in A shares, used to be very volatile from 14 to 15, that bull market. The velocity ranged from 2% to 6%. And so far in this rally, it's 3% to 6%. So I think it's gone ex-growth, far more steady, less volatile. So it is becoming a more attractive asset for allocation.
But Wendy, the risks are also becoming clear. Case in point, property, and we've been talking about Vanke delaying its second payment. Surely the real estate sector remains lackluster.
Yeah, indeed. I think real estate and construction combined back in 2018 was contributing close to 30% of GDP growth. And they turned negative in the last several years. And now we think it's going to be mid to single digit contributor to GDP growth once it stabilizes. So it's becoming far less important, but it's still very important at the headline level. My sense is looking at this credit case being dealt with at this point probably indicates confidence of the underlying economy. And bear in mind the best property assets, residential asset in Tier 1 cities, they still have very strict purchase restriction. Take a family in Shenzhen, for example, they can only buy 2 units within the prime areas. And as you've seen, that generation or fourth generation property has done very well. And they're, much more of an upgrade to the previous residential properties. And so these are the equivalent of Max 7 of S&P, but they're purchase restrictions. So I do think there are parts of the property market that could be eased and then change people's expectations and then concretely lift demand. So I think the ultra high end demand's been capped and then the credit issue is being dealt with. They're both positive signals. And now, lastly, you do have small banks being pressured to sell property direct because they need to keep a certain amount of liquidity on their books. And I see that as a clearing event. It's almost like September of last year. Equities were cheap, but there wasn't an anchor. And so people have quite a bit of doubts and bewilderment.
The key question and the key theme remains AI, whether to invest in the U.S. or China. If you're investing in China AI plays, how do you deploy your capital? What's a strategy that we should be adopting for 2026?
There are different slices within AI, to your very good question. There's the domestic, local providers. There's also the AI global ecosystem plays, and there's also the power electrification, ESS plays. We use our quantitative measure to look at the momentum and the growth. And the one that came out best right now is ESS. It's only in the recovery zone. And the broader AI, for example, the local and the global AI bucket, they're actually borderline slowdown. So their growth has been well recognized. It's still growing year over year, but people are unsure they're going to pick up quarter over quarter. So I think the best bet is in ESS. And in fact, ESS, the renewable ecosystem, they are at the intersection of the anti-evolution trends, electrification for AI, and AI data centers, and then also exports. So that's one of our most preferred thematic, ESS and renewable ecosystem.
Do you see greater... When did you see greater job dislocation as a result of AI in China?
Indeed, I think digitization, AI, that will replace or make obsolete a lot of the traditional businesses. So in due time, this raises the urgency of coming up with something on the Social Security side that has more universal income, in nature. And a lot of the changes or reforms in China are very much event-driven. It becomes pressing, then it needs to be dealt with. So I think for 2026, the optionality on the policy side, one of it is there going to be a further easing in property or some effort to put in a floor? And then the other one, which is a little bit more distant, is on the Social Security side because there are too many job dislocations.
Wendy, thank you so much for that. Wendy Liu, Chief China Equity Strategist at JPMorgan. Still ahead this hour, fighting flares again along the Thai-Cambodia border, threatening a fragile ceasefire that President Trump claimed credit for. We have an update next. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Thailand's military says it launched airstrikes along its border with Cambodia after clashes killed one Thai soldier and injured 4. Both countries have accused each other of breaching a ceasefire agreement brokered by Malaysia and U.S. President Donald Trump. Let's cross to Bangkok and our Thailand reporter Wendy Tantang-Knight. Wendy, what triggered this latest clash and why is it escalating now?
So just to recap, last month, there was a landmine incident that injured several Thai soldiers, and Thailand then suspended this U.S. brokered peace deal as a result of that. So that diplomatic guardrail is now gone, and that's part of the reason why we're seeing tensions flaring up again. What we're seeing now is another exchange of fire along the border, but this time it turned deadly. Now, the latest death toll for Thai soldiers are now up to 2 fatalities. Both sides, of course, claim the other fired first, but Thailand responded this time with airstrikes, which is the first time we've seen this level of force since July.
What does it mean then for regional stability and for President Trump's peace deal?
I think it's a real setback. This is the worst fighting since July when dozens were killed at that time. And the big concern now is that the Trump-backed peace accord could fall apart entirely. And that, of course, has economic implications, especially for Thailand. The peace deal is tied to U.S.-Thailand trade talks, and Thailand has already suggested that it's willing to prioritize national security over securing better trade terms. If these clashes continue, those negotiations could slow or even stall.
Should investors be worried, Randy?
So markets haven't reacted much to this yet, but I think we should be watching this closely, because if the fighting spreads, it could, add another layer of uncertainty for Thailand, which is already dealing with slow growth, deflation pressures, major flooding in the south. And the bigger issue is political risk. If this drags on, it could overshadow Thailand's economic agenda and priorities and make investors more cautious. And so, this is definitely something to keep on our radar.
Have we heard from Malaysia, or President Trump for that matter, because they were behind that peace accord?
We haven't heard reactions from the US president or the White House, but we have heard from President Anwar Ibrahim of Malaysia, and he just tweeted and saying, let me just pull that up right now. He's saying that he's deeply concerned by reports and, of course, asked both sides to work together to agree to the peace deal.
Wendy, thanks for the update. Thailand reporter Wendy Tantong Knight in Bangkok. Coming up on Inside, we speak exclusively with Biocon founder Kiran Mazumdar-Shaw about the deal to fully integrate their Biologics unit at a valuation of more than $5 billion. That's next. This is Bloomberg. Welcome back. You're watching Inside, and we're watching shares of Indian pharmaceuticals firm Biocon. The company will buy out minority shareholders in its unit, Biocon Biologics, via a mix of cash and shares in a deal that values the biosimilars unit at $5.5 billion. Joining us now exclusively, Kiran Mazumdar-Shaw, Executive Chairperson at Biocon and Biocon Biologics. Kiran, good to have you with us. You say that this deal is transformational. Just how significant is it, and what kind of transformation can be expected in the coming years?
So, Haslinda, great to be on your show again. And let me start by saying that if you recall, when we started the biosimilars business in partnership with Mylan, biosimilars was a business division of Biocon. And we've come a full circle to make it into a wholly owned subsidiary of Biocon, and we believe this is a very elegant outcome and a very good value unlocking for the company. So I am very pleased that this is where we have landed. I think all stakeholders have been basically given what they are due. And I think everyone should be very happy with this outcome. In terms of transformation, I think, Haslinda, I believe that bringing these two businesses together gives us a lot of synergies. And I think there's one big differentiation that we have. One is, of course, that we will be the largest company in this region in terms of having a large portfolio of both biosimilars and generics in the market. Apart from this, of course, we also believe that we would be very, very differentiated in the diabesity space, because we would be the only company globally to have biosimilar interchangeable insulins in combination with a growing portfolio of GLP-1s. So that's why I feel extremely, satisfied that we've reached this outcome.
Does owning 100% of Biocon Biologics change your long-term vision for your biologics business? And does it change your priorities? What are your priorities?
I think the priorities remain very much focused on biosimilars and the specialty generics that we have. And as you know, our portfolio is very differentiated. We are focused on diabetes, oncology, and immunology. And I think bringing these products together gives us a lot of leverage. I think it also gives us a lot of, efficiencies and synergies when it comes to our commercial engine, when it comes to our supply chain and our resourcing.
Do you think that this would perhaps expedite global launches, especially in markets like the US and EU?
Well, I don't think it would accelerate because obviously we are in those markets and, we have looked at launching at the earliest. So I think what this does is it actually gives you a lot of leverage in terms of combining these two businesses. And I think it's a very important outcome for us because it's a very elegant outcome for us.
Some critics at least have pointed to the scale of this deal, and they talked about, Biocon being exposed to financial risk as a result of that. How do you respond to such comments?
Well, actually, I would like to respond to that by saying that by combining the two businesses and making Biologics a wholly owned subsidiary, actually creates a much stronger balance sheet. And, in terms of the EBITDA, debt-EBITDA ratio that people have always been commenting on, it has already declined from 4.3 to 2.5, and we expect it to decline even further. So I think if you look at that, I don't think the critics are right in what they say. So personally, I believe this is going to see a very, very robust, fiscally prudent company when it comes to combining these two businesses.
And you'd imagine that the consolidation will help you compete with your rivals like Amgen as well as Roche. What do you make of the competition ahead in the next 12, 24 months?
So, Haslinda, we have been amongst the top biosimilars companies globally, thanks to the very strong end-to-end integrated model that we have created at global scale. And I think this puts us into a very strong position to, gain leadership in these markets. I think we've done very well in the US, where we have leadership in many of our oncology products. And we expect to do likewise in many, many other products. And we remain very focused on also the insulin opportunity where we are seeing huge traction.
Where do you see the biggest growth in the next 12 to 24 months?
I think, we are seeing very good traction in our biosimilars, and we expect to see very strong growth in what we call the diabesity sector, which is really the combination of, biosimilar insulins and the GLP-1s. We're very excited with what our portfolio holds for us in the future.
And we're also seeing tighter regulation in biosimilar standards. What do you make of that? Is it warranted? And do you see a further tightening ahead?
Well, actually, right now, the biosimilars pathways have actually eased because we are seeing, the potential waiver of phase 3 clinical trials, and that augurs very well for a company like ours. Because we believe that we have always had a very robust CMC package when we've gone to the agency. And we have seen that this has actually augured very well for us because we've always been regarded as a company that delivers very strongly on robust science and CMC. So I think this plays to our advantage, and it allows us to actually deploy our investments in R&D in a much more prolific way and a much more efficient way.
Kiran, some are suggesting that perhaps the consolidation we're seeing right now might just pave the way for the IPO of Biocon Biologics. Might that even be a consideration for you?
I do not believe that's the right perception, because we have done this with a lot of thought of value unlocking for all stakeholders, and we will remain with that decision.
In terms of the industry as a whole, do you see further consolidation?
I think this has been a very strong outcome for us, and I think for the industry as a whole, I think we are seeing companies moving into this biosimilar space with interest. But I think having global scale is going to be the competitive edge for Biocon.
Kiran, just taking a step back and taking a look at the healthcare industry in India, what's your take on its growth potential in the coming years?
Well, so I think India has always been leading the way in terms of generics for the global markets. And I think this will continue to be so. I think India has a strong competitive edge in terms of its cost and speed of development, and its integrated model. So I think it will continue to, do well in this particular pharma segment. We are leading the way in terms of biosimilars, and I believe that we will continue to see growth in our business, and we expect to see, other companies also trying to get into this space. But I think there will be the early mover advantage for many of us who have been there and gained market share and credibility.
As we head into 2026, what do you deem as the biggest risk to the business?
Well, right now, Haslinda, we have made a number of strategic investments. And we believe that this particular, move that we have made, this decision that we've taken, is actually playing to our advantage, and we're looking forward to the coming year as an inflection point of further growth.
And of course, speaking of growth, India has been growing at 8%, at least in the first half of the year. Do you see that pace of growth being sustainable?
Well, I do think India has the potential of growing at this pace and even higher than this, because I think there's a lot happening in India. I think the technology space is extremely exciting for us, all of us for that matter. Even our own business is benefiting a lot from, the new technologies like AI and machine learning. So I think you will see a huge opportunity for India to grow and sustain this growth at these levels. And I think the technology space is certainly delivering for India, and so is pharma.
Kiran, always a pleasure to have you on the show. Kiran Mazumdar-Shaw, Executive Chairperson at Biocon and Biocon Biologics. Coming up, we'll ask Bridgewater Associates founder Ray Dalio to weigh in on the Fed's rate path. That conversation is coming up next, live from Abu Dhabi Finance Week. Much more ahead. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Abu Dhabi Finance Week is underway, bringing together top bankers, investors and leaders to reflect on the future of global markets and capital flows to the Gulf. Bloomberg's Abir Abu Omar is there and standing by with our next guest. Abir.
Haslinda, thank you. We are in Abu Dhabi for the first day of Abu Dhabi Finance Week, and joining me today for the first interview on the ground is Ray Dalio, founder of Bridgewater Associates. Ray, thank you so much for joining us this morning.
It's a treat to be here, and it's a treat to be with you.
Thank you. So we are in Abu Dhabi. You come here pretty often. We were just talking about the weather in Abu Dhabi and how it is like. And so, since we're on the ground and you have presence in this emirate and you come here pretty often, what do you think it would take for the UAE, whether it's Abu Dhabi or Dubai, to establish themselves as global asset management hubs? Or where do you think they are in their cycles right now?
I think, as you say, I've been coming here for 32 years, so I've watched it evolve from the founder, Sheikh Zayed, to his children, and I think it is the closest thing we get to a paradise in a world that's increasingly in trouble. And they have a great investment management expertise because they have lots of money that they manage for themselves. But when it's coming to money management, that creates a community in which other investment managers come here, and it creates this vibe like a Silicon Valley of investing. So this statement of capital is not just a buzzword, or a slogan. It is that if you want to be in almost the Silicon Valley of investment management, there's an excitement to being here. And it's particularly enhanced by the combination with AI. I would say these are the two biggest commitments. We think of Abu Dhabi as being oil, and of course it is. But really now, asset management, because of the amount of assets they have and how they're doing it, and also AI, because of the commitment that they made earlier and now, is creating that kind of vibe. And that's bringing together very interesting people to create a happening environment.
And we'll get to AI in a second. I want to hear your thoughts a little bit more about that. But we have been covering the, you say capital of capitals, and that's definitely been the motto that Abu Dhabi has been trying to push over the past few years. We see a lot of people coming in here, especially at the AGGM where we are today. But what do you think it would take for Abu Dhabi to become a place where people like you and others come here to invest, as opposed to come here to invest into other places in the world?
Well, it starts with the investor who's knowledgeable, and then it creates exposure to good investments. So there's a lot of interesting good investments that are being made that have been made by those who are here. And so the partnership and the sharing of that, the ability to co-invest or invest in that, if you have people who are doing it and they're in the neighborhood, and then there's good things to invest in, it'll happen.
So let's turn a little bit more global. You've spoken recently about a big historic shift being underway, whether it is fueled by AI disruption, whether it's fueled by mounting debt levels globally. What do you think the consequences of such a crisis are in the short term, especially on global macro markets?
Well, I'm a practical investor. I've done this for 50 years, but in order to understand today, I had to understand things that happened before my lifetime. The big cycles, what causes breakdowns of monetary system. So I studied the last 500 years, and there are 5 big factors, 3 of which operate in a big cycle. There is the debt cycle, the debt money cycle, and I'll touch on that in a minute. There is, connected to the money and debt cycle, is the political cycle within countries, the left and the right. Gaps in wealth and values cause populism of the left and the right, which means that there are irreconcilable differences, so we have problems along those lines. And number 3, there's the geopolitical cycle, the world order, when rising powers challenge existing powers and existing systems. Those 3 are interrelated cycles: money, debt, the domestic economy, and the international economy. The 4th is through nature. Acts of nature, droughts, floods, and pandemics have been a big factor. They have killed more people than wars, and they can play a role. Certainly it's playing a role. And then always throughout history is man's inventiveness, particularly of new technologies. And the inventiveness that we're seeing of the new technologies with AI particularly is clearly a force. So now, how does that play out? The first force is that we are having too much debt. Now, this is not just the United States. You're seeing this in England, you're seeing this in France, you're seeing this in China, you're seeing that dynamic. so that they can't increase the debt the way they did before. And then related to that is the politics. When you have these large wealth gap differences, who has the money? And when there's the accumulation of a lot of wealth that then isn't taxed, there's a tendency to want to tax that wealth. And that creates bubbles. In other words, when wealth is very different from money. In order to spend money, you have to sell wealth and get money. And when there's a lot of wealth that needs to be sold. So quite often interest rates play that role, but you could see wealth taxes play that same role, meaning the need to sell that. And that creates a bubble. So we have a debt bubble going on. We have that other kind of a bubble going on in the economy and related to politics. And then, of course, geopolitics. Capital flows and trade flows are different because we have a world in conflict. And in that world in conflict, no country could be secure. So that's why the United States wants to build self-sufficiency in these areas. Or China, which is that model where China would export to the United States and earn money and then invest in bonds, is no longer a viable path because the Chinese worry that they won't get paid on their bonds like the Russians don't get paid on the bonds. So that dynamic is what is behind what's happening, and it's becoming more precarious as we go forward. Like if we go into the 2026 elections, it's likely that the Democrats will take the House. Significant possibility. If that happens, the political conflict will continue to be more difficult, and so on. And that's creating this risky environment. Particularly also, debts are maturing. So you have to roll over your debt at a higher interest rates. This confluence of factors is making the environment more risky as we're going ahead.
And I want to talk a little bit about what sort of concern investors globally are underplaying. But before that, you talk a lot about AI, and I wouldn't be a financial journalist if I don't ask you a question specifically targeted AI, especially in Abu Dhabi right now. Bloomberg reported a couple of months ago that a venture that your family office had with G42 did not pan out. Are there any other partnerships in the city we should be on the lookout for?
I'm very active in doing AI partnerships and in areas of common thinking, AI and investing. In other words, I guess I would say we're in this environment where there's a networking of different people have different expertise. And I think as we're dealing with how to be the best investor, you have to have the ability through AI to do that. And the partnerships are thought partnerships of how everybody can, teach each other and do things together. So, yeah, there are a number of things that are interesting and going on, and I'll keep you posted as things develop.
So let's go back to the risk that global investors are underplaying. Out of the 5 forces that you had mentioned, what do you think is the biggest one that investors are not paying enough attention to?
I think it is the debt service, particularly the government position in the supply-demand of that debt, combined with the politics. What's happening in all of these governments is that they can't increase their spending because they can't increase their debt. And at the same time, they have the needs, more military spending and so on. And at the same time, they can't cut taxes. And so you're seeing a lot of political turnover. In the UK, they've had 4 prime ministers in the last 5 years. Same has been true in France, because there's not the ability to deliver on the economic promises that they're making. So I think it's the confluence of that economics, that situation, and the politics, the debt dynamics working with the politics, working then with this technology adding into it in a bit of a technology bubble.
So final question.
So that concerns me the most. And I would say particularly post-26.
Does that mean that you said recently that 15% allocation in gold and Bitcoin, do you still stand by that line?
I think that everybody should realize that gold is a type of money. It's not something to speculate in, just as you would hold cash. But other cash is a fiat money. And when you have debt, then the government needs to print money and make money easier, which lowers the value of that money. And so also to recognize that gold is a diversifier. When the other parts of the portfolio do badly because of some of the things we're talking about, gold will do better as a diversifier. So it has the effect in such times of raising the returns and diversifying the portfolio. A normal allocation would be between 5 and 15% if you just went into a portfolio optimizer.
Thank you so much, Ray, for your time today. Haslinda, back to you at the studio.
Bloomberg's Abu Omar with Bridgewater Associates founder Ray Dalio at the Abu Dhabi Finance Week. Now, before we go, here's a look at tomorrow's show. Papastone research strategist Dylan Wu will join us as markets await this week's Federal Reserve rate decision. Plus, we'll dig into the outlook for property in the year ahead with Knight Frank's Christine Lee. That is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.